Hey everyone, it's John again. Welcome back to the channel. If you ever felt totally swamped by all the investment options out there, or you need a finance degree just to figure out where to put your money, then trust me, you're not alone. But what if I told you that for your entire stock portfolio, for your entire life, you just need 3 super powerful, low-cost funds from Fidelity? Seriously, it's not a magic trick, it's just smart investing. This is my exact setup for most of my investment accounts. Today, we're cutting through all that confusion to show you how you can totally simplify your money game. We're talking about FSKAX, FTIHX, and FXNAX. These 3 Fidelity funds, when you put them together the right way, give you amazing coverage, keep your fees super low, and let you pretty much set it and forget it. This strategy can work for you from your very first job all the way to retirement. The great thing about this 3 fund plan is how easy it is. You're not trying to pick the next Amazon stock, guess what the market's going to do next week, or spend hours reading economic reports. Nope. You're just riding the big wave of a global economy growing over time. The main idea here is spreading your money around a lot, like a lot. By owning these 3 funds, you're not just putting your eggs in one basket or even a few baskets. You're basically investing in thousands of companies across the whole US stock market, thousands more internationally, and a ton of solid US bonds. This basic strategy protects you from getting hit hard by problems with just one company, letting you sleep better at night knowing your money is diversified globally. Alright, let's get to know these awesome funds. Each one does something specific, but they all work together like a dream team for your money. First up, we have FXKAX, the Fidelity Total Market Index Fund. This is your main player, your solid foundation for getting exposure to pretty much the entire US stock market. When you buy FXKAX, you're essentially getting a tiny piece of almost every publicly traded company in the US, from the big guns like Nvidia and Google, all the way down to the smaller, growing companies. It basically tries to copy how the whole US stock market performs. So, what's that mean for you? It means you're not trying to guess which stocks will go up. You're just hopping on the steady growth train of the American economy. Historically, the US stock market has been a fantastic way to build wealth, and FXKAX lets you grab a piece of that broad success super efficiently. Its fees are extremely low at 0.015%. This means for every $10,000 invested, the annual fee would be just $1.50. That's a huge deal for long-term investing. Even tiny differences in what you pay in fees can cost you a ton of money over years and years. FXKAX gives you affordable access to a super diverse mix of US stocks. It's a must-have for anyone investing for the long haul. Next, we spread our wings to the rest of the world with FTIHX, the Fidelity Total International Index Fund. While FXKAX covers the US, FTIHX makes sure your portfolio has solid exposure to the rest of the world's developed and emerging markets. This fund tracks a big global index, giving you access to companies in places like Europe, Asia, Australia, Canada, and Latin America. Why is investing in the US so important? Because the US market won't always be the top performer, and having investments globally can help smooth out the bumpy rides and catch growth opportunities whenever they pop up. Think about it. Cool new ideas and economic growth aren't just happening in one country. By adding FTIHX, you're getting a slice of companies like Toyota in Japan, Nestle in Switzerland, and Samsung in South Korea. This fund keeps you from putting too much of your money just in your home country, which is a common mistake. A truly smart portfolio understands that the world is connected and growth can happen from anywhere. FTIHX gives you this important global variety with an ultra-low fee of 0.06%. Finally, bringing balance and some calm to your portfolio is FXNAX, the Fidelity US Bond Index Fund. This fund invests a wide variety of reliable US bonds, including government bonds and corporate bonds. Its main goal is to follow how the overall US bond market performs. While stocks are all about growth, bonds usually play a different role. They offer stability, tend to be less wild, and provide a steady income. Especially when the stock market is acting crazy, bonds often hold their value or even go up, acting like a shock absorber for your portfolio. As you get older to retirement, or just decide you want less risk, putting more money into FXNAX can help protect your savings and make your portfolio less jumpy. It's like the anchor that keeps your investment ship steady when the financial waters get rough, making sure you have a safer spot for some of your money. And yep, it has a super low fee of 0.02%, so more of your money stays with you. Now that we know what each fund does, let's talk about the secret sauce, asset allocation. This is all about how you split your money among these funds based on your own situation, how much risk you're okay with, and when you'll need the money. The awesome part about this 3-fund setup is how flexible it is. Your portfolio isn't set in stone. Instead, you change the percentages you put into each fund as your life changes and your money goals shift. The general rule, often called a glide path, is to slowly move from having more stocks, FSKAX and FTIHX, to more bonds, FXNAX, as you get older. Why? Because when you're younger, you have more time to bounce back if the market dips, so you can take on more risks for potentially bigger gains. But as you get older and closer to retirement, protecting your money usually becomes more important. You have less time to recover from big losses, and your goals shift from growing your money super fast to keeping what you have and getting a steady income. That's where bonds become your best friend, acting as a common force. Let's look at some common examples by age, but remember, these are just starting points. You need to figure out what feels right for your risk level. The worst thing you can do is panic and sell when things get tough. In your 20s, you might go ultra aggressive, like 100% stocks, maybe something like 60% FXKAX and 40% FTIHX. You've got decades ahead to let your money grow. In your 30s, you should dial it back just a tiny bit, like 90% stocks and 10% bonds. So maybe 55% FXKIX, 35% FTIHX, and 10% FXNAX. You're still in wealth building phase, but we're toning down the level of aggressiveness. In your 40s, a common split for this age range might be 80 to 85% stocks and 15 to 20% bonds. For example, 50% FXKIX, 35% FTIHX, and 15% FXNAX. You're probably making good money and retirement is getting closer. In your 50s, you'll keep shifting towards being more conservative, maybe 60 to 70% stocks and 30 to 40% bonds. An example could be 40% FXKIX, 30% FTIHX, and 30% FXNAX. Protecting that nest egg becomes super important. In your 60s and beyond, your bond portion might get much bigger, like 55% stocks and 45% bonds, or even more bonds depending on what you need for living expenses and other income. For instance, 25% FXKAX, 15% FTIHX, and 60% FXNAX. This gives you income and stability for your retirement years. The cool thing is, you don't have to overthink it. Just check your percentages once a year or when you add a bunch of new money and make sure they match your target. This process of rebalancing is a smart move for long-term investing. Let's do a quick recap of why this 3-fund Fidelity portfolio is such a winner for your whole investing life. Massive diversification. You're invested in thousands of companies worldwide and tons of bonds, which seriously cuts down your risk. Super low costs. Index funds have tiny fees, meaning more of your hard-earned money stays working for you, not going to someone else's paycheck. This can save you a fortune over the years. Easy peasy management. No need to do crazy research or constantly check your investments. It's truly a set it and forget it kind of deal, which frees up your time. Tax smart. Index funds are generally more tax friendly than other types of funds because they don't buy and sell stuff as often. Proven to work. Over the long run, these kinds of broad market index funds have historically beaten most fancy, actively managed funds. You're basically betting on the overall growth of the entire global economy. Flexible. You can easily change how much you put in each fund as you get older, making sure your investments always fit where you are in life. To get started, if you don't have one already, open a brokerage account with Fidelity or on another platform where you're able to buy Fidelity funds. Then, set up automatic contributions, even small ones, into these 3 funds. Remember, putting some money away consistently is your secret weapon. Check your allocation once a year and make those tweaks as you move through your life decades, slowly adding more bonds. Building wealth for the long term doesn't have to be rocket science. By going with the smart simplicity and amazing diversification you get from FXKAX, FTIHX, and FXNAX, you can build a strong, low-cost portfolio that's designed to grow with you through every stage of your life. This strategy isn't about chasing the next hot stock or trying to predict what the market will do tomorrow. It's about being disciplined, thinking long term, and using the incredible power of compound interest and steady growth of the global economy. It's about making your financial life less stressful and giving your money the best chance to grow. So, if you're ready to make investing simple and secure your financial future, definitely check out these 3 powerful Fidelity funds. They might just be the only ones you ever really need.